Hey guys, in this video I'm going to talk about three stocks I'm going to be buying up this month. They're undervalued, have great potential upside from here, so let's hop right into it. All right, so the first stock here on my list is Adobe. I'm sure all of you are familiar with it. More than 100 million people use Adobe and their products daily. And I just wanted to show you this chart because it's pretty impressive. If you look at revenue versus the stock price since 2018, they're growing at 17% a year quarterly. From 2018 to 2025 here, yet the stock price has declined. It's only up 18% since 2018. So I think this poses a very unique opportunity for such a large company integrated into the professional side of things, right? I'm sure you guys have seen the joke of like a guy holding up the globe, like all of the world is resting on his shoulders, and it's Excel, and it's Excel holding up the whole financial markets. Well, it should really be two-pronged, right? Because as much as Excel holds up the professional financial services market, so does Adobe. I mean, everything done in Excel is exported to PDF. Investment banks, private equity firms, CPAs, anyone making a report is running it through Adobe. I mean, retail isn't their customers, right? It's these big businesses. And just try to frame this for you from a valuation perspective, looking at the price to earnings ratio from 2016 to current, it averages at about 48 times. That's 58% below its historical average of 48 times right now. I mean, it's trading at 21 times earnings, and it's still growing by 15% plus a year with incredible margins, a Rule of 40 company. And in Adobe's recent investor presentation, they had some great stuff to show, what's coming in their products in the near future. An example for Photoshop they went through was, AI being inside the app through Firefly and how all the amazing things you can do with unusable photos or static photos and, turning them into new ideas is really creative. I mean, it makes you think a lot like this Google scenario that happened a couple months ago. I think people thought that LLMs were going to come in and take away Google's search results, just like people are thinking Figma and Canva are going to take over, these digital editing and exporting. I just don't see it. It is so ingrained into professional services, and you can tell it by the ROIC, and you can tell by the consistent quarterly revenue growth. I mean, this company is excellent. And the icing on the cake here is that the CEO said, "We believe our stock is undervalued due to people focusing on techs and chips right now, and we're buying back a lot of our shares." I mean, this is exactly what you want to hear from a company. They're putting their money where their mouth is. They're saying it's undervalued, and they're buying back. They have a $50 billion stock repurchase plan. They've only used 9 billion so far through 2025. All right, so the next stock on my list here is Duolingo, and I've been waiting a while to get in on this stock. It was just priced a little too expensive for my taste, a little rich for my blood, so to speak. But the fundamentals are terrific. They're truly Netflix-esque when you look. Even too, it's good in mind to keep in mind Netflix and Spotify. If you ever track those stocks and their daily users. Over time, you can see that there were periods where Netflix flatlined, Spotify flatlined, and they dropped 60, 70%, and they just got stronger from here. I really encourage you to take a look at that. But just taking a look to speak to Duolingo's strengths, revenue's up 136%, free cash flow up 82%, free cash flow margins at 30 plus. It's well above a Rule of 40 company, but their market cap's down 6% from Q4 23 to Q3 25. And I know their bookings number came in a little softer than what Wall Street was expecting. And I know people are getting worried about the monthly active users decelerating in growth, but I mean, again, it goes back to that point in Spotify and Netflix. Look back at those charts. Look back in find a quarterly investor report with Netflix, and you can see when their growth flatline, they dropped 70%. Same thing with Spotify. It's just ebbs and flows. I mean, when you look at things quarterly instead of last 12 months, you're going to get a lot of inaccuracies, in my opinion. And I'm just struck by how amazing these numbers are. I mean, everything revenue, subscription revenue, monthly active users, paid subscribers. It's a thing of beauty here. The stock currently trades at $201 and is down 60% in 6 months, absolutely getting hammered this year. And I've been waiting for an entry point here, and I think this is my entry point, and I did buy. When you look at the price to earnings ratio, you'll kind of see why I was waiting. The company wasn't really profitable yet in 2021, so there was no, actual price to earnings ratio there. Then they became profitable 210 times earnings, 82 times earnings, 63 times earnings. I mean, Google and tech companies like that trade in low 30s. I mean, it was very, very expensive. And now 22 times earnings. I mean, I'm looking to take a big old bite out of this. Extreme upside from here in my eyes when they get all of their verticals down and expand into more areas. I mean, what they've been doing with chess and the results they've seen on their chess platform when not even having code written 1 year ago, I mean, is unreal. And I just wanted to show you this chart to show you the truly unique opportunity. I see everyone saying, don't buy Duolingo. I'm telling you, it is an opportunity right now. Take a look at this rule of 40 versus enterprise value to free cash flow. Okay. Who's trading at the lowest EV to free cash flow? It'll be Duolingo, Workday, Salesforce. I don't know if ZM is Zoom. I forget their ticker. But you can see, the lower you are to the y-axis, you are, lower EV to free cash flow ratio, and the further you are to the right along the x-axis is how strong you're on the rule of 40. So not only do they have the strongest rule of 40 of all software companies reporting out last quarter, but they're also only two companies trading lower multiple than them, which is CRM and ZM, and they're not growing like Duolingo is growing. So the next stock I have here on my list I'm buying this month is Baidu. Basically, it's the Google of China and has its own self-driving platform in Apollo Go. The market's been sleeping a lot on China tech, and they've quietly been spending years building a very deep artificial intelligence infrastructure. They're one of the few companies globally with true vertical integration with, in-house chips, foundational AI models, cloud, leading autonomous driving platform. The question is not whether Baidu has the capability, but really what multiple, will fit this kind of tech stack. And it's really interesting too, because you see people like the CEO of NVIDIA, Jensen Huang, making a comment saying, China's going to win the AI race, or China's right behind us in the AI race. And, a lot of these companies still are priced very undervalued. And I get they won't carry the premium US stocks have, right? Because a lot of other companies aren't going to use their cloud because it's a government controlled company and they don't want to give China all that access. But they still have a lot of things working for them here. They have a very compelling valuation. They're the leader in China's robotaxi market, and they're going to hit profitability by the end of 2025. They'll potentially be benefiting on this U.S. chips, export ban with the improving China-U.S. relations, and China has a massive stimulus package that's just rolled out. Baidu's AI investments are paying off nicely. In Q2 2025, AI cloud revenue surged 27% year over year. Baidu's robotaxi service, Apollo Go, hit a major milestone with 250,000 fully driverless rides per week globally, matching Waymo's volume with a fleet of 1,000 plus vehicles and 14 million plus total rides. I mean, this isn't hype anymore. They're scaling and scaling quick. They have international partnerships like Postbus in Switzerland, European expansion, launches in Dubai and Abu Dhabi. I mean, these moves could unlock a whole new revenue stream for the company. In my mind, the stock's projected to explode, and I'll be watching closely for their next earnings report on November 18th. And just to show you the valuation metrics on the stock, it's only trading at 2 times revenue and a PE ratio of 19 times. I think if investors start switching and seeing the progress being made in China, we could easily see a 30 times price to earnings multiple here, which gives it about a 30% upside. So those are the three stocks I'm buying this month. Let me know what you think, if you'd buy any, if you sell any, or if you disagree or agree in the comments. Thanks, guys.